I'm learning every day. I don't know about you guys, and it's time to learn a little bit about the VIX. Tim, welcome back to Face.
How you doing, mate? Yeah. You're not going to learn much about the VIX from me.
Well, you're a VIXologist, so
No.
you're not a proctologist, so I figured I'd learn about the VIX.
Only in my spare time. No, I don't trade the VIX at all. Don't really just look at the VIX as a kind of parallel to what we're expecting volatility to be in the S&P 500. That's okay. Really the extent of my VIX knowledge. No, we're much more focused on the macro side of things. What's going on in the macro world.
All right, Tim, you want to share your screen?
Yeah, let's go for it.
Go to share screen. There you go. You could do it now.
Okay, there we go.
I do have the handle right, Tim, right?
Yeah, but that's from my surname.
Okay.
Nothing to do.
All right.
Well, it's kind of to do with volatility, but nothing to do with trading volatility. More my temper.
Okay, because I was ready to ask the question on the decline that we saw here. The VIX really never performed. There'd be days when the S&P would be down 40, 50 handles, and the VIX was barely positive at times. So did you notice that?
But you've got to look at the VIX in the sense, I look at the VIX as a barometer of expectations. So when you've got the VIX up where it was at 25, we're expecting sort of 1.5–2% moves every day. Kind of to allow for a bit of variance around that, and and if we're getting that, then there's no reason for the VIX to continue trading higher. Because it's sort of meeting expectations more or less.
Great point.
That's the way that I use it. It's really just it is what it says. It's a measure of volatility, and expected volatility.
Okay.
So yeah, I don't really go beyond that with the VIX. That's all it is. It's just something. And some of the guys that trade the VIX as well. You must have spoken to some of them. Jesus, they're so intelligent. Real inferiority complex.
They're rocket scientists.
Yeah, completely.
Yeah. So I see a little triangle you have up here on the S&P.
Yeah, that's it. There's a few things that I've kind of prepared here today that I wanted to chat about, because obviously, as I say, we're looking at things more from a macro perspective and trying to zoom out and get out, outside of all the day-to-day noise, and really sort of get a handle on what's going on, and where those larger trends might come in. And at the moment, obviously today with the ECB meeting, it's all about the euro and these spreads that I've got up here on the screen right now.
Right.
Okay, so what we've got here, all right, is I've just brought in a couple of spreads, all right, between Italy and Germany, all right, because obviously aside from the the ECB are hiking. That should mean that the euro should go up because they should close this gap that we've got over here on the right, which is the difference between the US 2-year yield and the German 2-year yield, which we use as a bit of a proxy, for the interest rate differential trade there. And to me, I'll be honest, technically, it does look like the euro wants to break out to the upside.
Yeah.
But from a fundamental perspective, I'm still not convinced by what else is going on with the eurozone as a whole. I think what they're doing at the moment is they're pushing. They've got to do something, obviously, because of the inflation and the level they have to respond. It would be sort of irresponsible of them not to. But where we're going to run into problems, I think, is maybe 3 months down the line, perhaps towards the end of the year, where the markets, I think, really going to start looking at these higher rates and start assigning this premium back into Italy and the other sort of peripheral countries. And the ECB is going to have to be credible about how they're going to manage this spread that we call it between, say, well, look here, I've got Italy and Germany.
Could I throw Greece in there too?
Yeah, throw Greece in there, definitely. Okay. Italy and Germany I'm using because that sort of is the main benchmark that everyone looks at. Like, when it's the one when everyone notices, when this one really blows out. And just since the meeting here, if I just dial down a little bit to the hour.
So the technicians are supportive of the Euro USD, and the fundamentals, you're not convinced about it yet.
No, not convinced at all.
So what do you go with as a trader? You may have a bearish backdrop fundamentally, but the charts are saying there's going to be a rally. Do you go with the rally, or because of the fundamentals, you let the rally go and look for shorting opportunities?
Yeah, you have to let the rally go. You have to. We're seeing it across all kinds of markets. Fundamentals, they matter at different times, but they don't matter all the time.
Right.
You know, there's sort
That's
of
right.
you tend to get these turning points, you know, where all of a sudden everyone's worried about something, even though it's largely been talked about for months. You know, I mean, even the ECB statement today, they've already mentioned the fragmentation, you know, the potential fragmentation risk. And what they mean by that fragmentation is obviously the spread between, say, Italy, which has got this massive debt load, you know, and really that the higher interest rates go, the more the risk of default is for Italy. It's essentially, if you break it down to the simplest terms. So the spread between the kind of, if you want to put it into sort of bond terms, like corporate world, you know, you've kind of got this prime bond, which is the German Bund, and then you've got the junk bond, which is Italy. And if the spread between the two of those becomes too much, then you get into the kind of sovereign debt crisis world, and what's going to happen, and the uncertainty will generally see, you know, people fleeing the euro markets as a whole. Which obviously we saw, was it 10 years ago now, wasn't it, since Draghi had his moment?
Yeah, are you looking for 2.0 on this?
I mean, potentially. I think what we need to see now is what actually happens next. I don't think that the ECB can keep raising interest rates, you know, to anything like the level that they're talking about today with this kind of sustained increase, unless they can put together some kind of very credible tool, which I think is going to be very controversial in Europe, because as we know, it's already quite a political project, whereby essentially they're centralizing the debt, you know, into these euro bonds, which no one really wants, and they kind of approved a few of them in the pandemic under an emergency, but that's about it. So they've got the reinvestments that they can play with, you know, where they can basically reinvest European, you know, they can reinvest more, say, Italian bonds as they come due, and less of the German bonds, and try and manage the spread that way. But that's not really a sort of permanent solution. So, I mean, you know, I'd be fascinated. They say they're working on something. There's been a couple of leaks that have sort of come out about them working on a tool, but there's no real details about it yet at all. So that's something that we're really watching for the euro. And I think, you know, as I say, you've got to go with the price, but you've also got to be aware that, you know, it's not necessarily going to be a kind of forever trade. You know, I mean, but they never are they? But it's not going to be a kind of medium-term trade. I mean, I don't think the euro can really sustainably break out from here, because I think we're going to see the US go above neutral. I think we've done. Actually, I'll tell you what. Let me bring up the dollar yen chart over here. All right, now.
Yeah.
Obviously, we've, you know, the move in dollar yen has been just exponential, just absolutely off the scale. Meteoric, yes. But again, unless the Bank of Japan are really prepared to do something, or something else breaks somewhere in the world, then I don't see any reason why we don't just follow this pattern again. You know, we had this spike higher here where we really just pushed on. We kind of pulled back. I mean, that's pretty much a textbook flag. We've broken higher again. You know, obviously the speed of this is what the Bank of Japan and the Ministry of Finance are really pushing back against. You know, they're saying they don't want the yen to devalue too fast, but they're still very much in the mode of a weak yen is better than a strong yen as a general kind of economical tool. And I mean, and this is something that I never thought you'd sort of even have anyone talking about is why would the Bank of Japan ever raise interest rates? We're in this kind of negative or low interest rate world forever. And yet here we are doing this. And imagine now that inflation doesn't come down, as I suspect is going to be the case. It's not going to come down. It's going to come down. Sorry, it's going to come down, but not as fast as the Fed and other central banks would be comfortable with.
Well, the general uptrend has some peaks, and you know, where it pulled back a little, then go to higher highs. I think that's what happened in the 70s. There were a few times it looked like maybe they had broken the back of it, but it was just temporary, and then you had another surge. So you're looking for something like that. I didn't think you were around in the 70s. Were you?
No, I wasn't. I definitely wasn't around in the 70s, mate. No, I was a glint in my parents' eye.
Okay.
But yeah, I mean, this is the thing now. So I think you're going to see potentially, especially with the Bank of Japan, especially with the yen and the euro, basically these low interest rate currencies. I think you're going to see them struggle again. You know, they're now there's a pause now where they're going to try and catch up. You know, well, the euro is going to try and catch up. The Bank of Japan are just in their own sort of world. The euro is going to try and catch up, and we're probably going to see, you know, maybe we get above neutral in Q3, or get above zero, apologies, in September. Whether or not that's 25 or 50 is still up for debate. But then beyond that, I think the Fed might have to press the accelerator again. And that's really where we're going to open up the next leg of the trade. So, we'll see.
Okay, so short term, so it's a little bull market pullback in the dollar, and then a resumption of the uptrend.
Yeah, that's really what I think.
Okay.
Mainly because of energy as well. Everywhere you look, and I was talking today, I did one about just a little bit about the sort of the layers of supply and demand in the gas market, because yesterday, we had this here. Okay, so this is the thing. So obviously, just trying to explain it with a bit of a meme. The global energy crisis, you had the explosion at a Texas gas facility and get US prices fall 7.7%, and everyone goes, huh, what's happened there? And obviously it's because you've got this kind of, it's a global market, but obviously it's sectioned off. So obviously what that means is more gas stays in the US, and that kind of that shortage of supply is transferred then to Europe, which is why we got this move in the Dutch, the Dutch benchmark today over in European gas markets. And I think there's a lot of people that got very confused by this kind of thing, and we're seeing this, the global undersupply, prices should be going up. But if you notice, European storage is already filling up. So this will be fine for a while. But if anything else happens with Russia, or if we have a particularly cold winter, or any of those things come to pass in the winter, then obviously energy prices are just going to keep going up again. And what does that mean? And that energy is everything. Energy filters through absolutely everything in the economy.
So maybe we may have a little respite here in the summer and fall, and then it becomes a weather market, demand increase for heating.
Quite possibly. And obviously there's only so much storage as well.
What do you think could happen in Russia? What else could happen in Russia to be more bullish oil?
To be more bullish oil? It just essentially, all that really needs to happen is for Russia's output to keep sort of decreasing. It's already decreasing now. Because of the inefficiencies because obviously before there, this lovely efficient pipeline, straight into Europe and everywhere else. Europe got their cheap gas. Russia managed to get out as much as possible. Well, now that's not going to happen as much. Gradually it's going to decrease. Then obviously they've got to reorganize all of that supply chain, which makes it less efficient, which means they're not going to be able to produce as much because there's only so many tankers in the world that can get it around the world. And all of those things. Could we see 80,
Tim? Could we see 80 if things come together before we see 150, 200?
I think 80 might be a stretch too far, to be honest. I think, unless you, the thing is, anything can happen in the oil market at the moment because of the way liquidity is and everything else. But I don't see it happening unless we really get into sort of recession slowdown fears. And I have got my concerns about China there. I really have. Everyone's very much on the China reopening trade at the moment, and they're talking now.
And there's a story today, copper's down because they fear that they're going to shut down again. And I actually interviewed a guy who said they can't open up again.
It's just they can't open up again. Why can't? What's the reason? Why can't they?
I don't know. Maybe their COVID policy, maybe they can't stop this and they do for a little while, reopen, and it's not a full reopening and they have to lock down again.
Yeah, I don't think that's going to go. I don't think that's going to happen. I think that as much as we look at China as this kind of big, powerful, all-powerful communist state that the people bend to their will. We also saw a lot of social unrest before. Unemployment's already at very high levels according to the official stats over there. So I think they're going to have to give it up and really try and find new. Basically like we did in the West, we started out with these really severe lockdowns and then we kind of, we loosened it a bit and we went back a little bit, then we loosened it some more, went back again, and I think that China's going to follow a similar path. It might not take as much time perhaps, because they'll hopefully have learned some of the lessons from our kind of, our experience with it. But yeah, I don't see them locking down as severely as they did, over the last few months.
Okay.
Yeah, go on.
No, you've wanted to talk about your S&P chart and the triangle and probably talk about what you think is going to happen here.
To be honest, actually, the S&P chart is more a cautionary tale, all right, for me, that I don't know what's going to happen here, All right, I don't have any. I have maybe a 55% bias. Okay, that will push higher, just because I think that's the one that makes least sense at the moment. So why shouldn't it happen?
Okay.
But really, you look where we are on the chart. We're in no man's land, absolutely in no man's land. We've got this. We're consolidating here because we haven't got the next impulse. We need a catalyst, which maybe the CPI print tomorrow might be, but it might also just extend uncertainty. We'll see. But it seems like everyone wants to play the peak Fed trade. That's my feel for the market at the moment.
But everyone's hoping for a good number. No one's talking about a bad number.
Yeah.
Maybe we get a bad number and they can't crush the S&Ps. That would be a pretty good tell, wouldn't it?
Definitely.
Because the bonds are on the verge. I don't know. I look at TLT, the 20-year proxy, and it sure looks like we should have one more low coming in that. So
I think so. And again,
this seems to be the acid test for a lot of different markets, how they could handle this next push up in yields on the long end. Is there anything that you have high conviction about in this climate, or you feel kind of
no, that's exactly not really. Just again, it's sort of timing wise. There's certain at the moment there's not much to have high conviction about because we're all watching the CPI number, and I mean this is something that I talked about today, and I did this little graphic in today's notes, just a silly little thing, but just to try and illustrate what I think you should be doing most of the time, but especially in this environment, is that you're looking at all of these things which are all competing for your attention. What people are thinking, what's the drivers, are we going to go higher, are we going to go lower, and all of those. And then I think you just have to estimate the benefit that's going to be delivered by each action and select the most effective one. So which trades do I want to do in this environment? Well, there's not many. There's really not many. It depends on the catalyst, depends what happens. But generally, you've got to be really selective, especially in this environment. And it pays you well in most environments, but sometimes you can get away with it. And this isn't that time. So here trying to call the direction of the S&P 500 sort of for the next leg, I think is a fool's game at the moment because it depends on what happens. Simple as that. So as you say, if a high CPI number comes in and we can't go down, what goes down must go up. And I think then that we can possibly get a bit more of that kind of, that was close, we've got away with it. If we can get up towards this 4,300, 4,300 up here, then maybe we can get that kind of a bit more bullishness. And then obviously then we can perhaps see a next leg down, which I do think we're going to see because I think higher interest rates are a feature of the next year or so. As I say, unless there's a recession. And if you look at the data at the moment, again, we'll see what happens in the winter, but certainly through the summertime, people are desperate to go on holiday. They're booking their holidays. They're still spending. They're putting money on their credit cards. They're not necessarily buying all the stuff that the stuff that all the transitory guys were talking about with Target and Walmart. They were saying, it will be the bullwhip effect. It will be the bullwhip effect. They'll buy too much. It will be the bullwhip effect. And it was, but it just took so much longer to materialize than I think people realized it would. Now we've got, the goods side of things, that's going to help with inflation on one side, but it's now extending again. You look at travel. Now travel is a big part of the service sector that we're going to see through the summer. Obviously travel, one of the key components of it is fuel. And obviously that's why fuel prices are going higher. There's no real spare refinery capacity to kind of really help out with that.
Right.
So where does that relief come from in terms of inflation?
Not from food unless we get rain.
Yeah, very true.
Yeah.
It's a bleak picture, but I think partly because a lot of us, a lot of people have seen it coming sort of a way off. I think it's already some of that was already in the price when we fell to 3,800. Now we're kind of in the range where everything is known for now, but now we're thinking, right, there's two kind of courses of action here. Either the Fed has to get into positive interest rates, so above neutral, above, even maybe above the rate of inflation. I mean, Jesus, that would be something. But, at some point they have to do it. I mean, there was something that we covered. Let's have a look here. So this was February, right? Where, do you know Zoltan Pozsar, the Credit Suisse guy?
No, I don't know. Go ahead.
Okay, so he's a guy that's he's well into the sort of the market plumbing and all of this sort of stuff. But then he kind of started coming out with a few things about what might need to happen. Okay, and he was talking about, he went full off piste as we've written here and called for a Volcker moment. Yeah, which again, he was really what started the kind of Volcker thing coverage in the media and everything else.
Okay.
But basically, what we're seeing happening already, mortgage rates going up, interest rates going up, is sort of starting to bring down the rate of, the kind of the rate of change in house prices, in stocks, all of those things. And we're seeing that in the housing market. Mortgage rates are up. It's slowing right down. So all of that side of things is happening. But what we've kind of got to do now is work through all of these reserves that people have built up, in terms of their wages, what they're actually living on, their savings.
You mean their balance sheet, consumers' balance sheet? Yeah,
the consumer balance sheet, and also the capacity to take on more credit. Because I think a lot of people, if you think about, what we've seen over the last couple of years, a lot of people got good pay rises, and they're feeling wealthier, and in a lot of cases they're able to pay down debt as well. So they're probably not at the edge of what they can service in debt right now. It's obviously going to come later if they try and remortgage their house or anything else, which who's going to do that right now unless they really have to, with the interest rates having moved as fast as they have. But for now, they're pretty comfortable. A lot of people manage to lock in mortgages at lower rates.
Oh yeah, they couldn't find a place to rent cheaper if they sold. Yeah.
Well, but the rents have gone up as well. But yeah, it's something.
They've gone up a lot here in the US.
Yeah, that's doubled. It. So as long as you're not renting, and again, as long as your wages have moved up, then
the only way they're going to sell is if they don't have a job and they don't have any credit left. Pretty much.
And this is where I think the interest rate story comes from, because I think the Fed really want to, to clamp down on demand and sort of crush the demand, but they're going to have to try harder. Unfortunately, it takes time, and unfortunately, they haven't got the luxury of that time right now.
There's too much leverage in the system. Let me tell you something.
Yep, that's it.
It's like from a moment of debate with Mondale. I traded under the Paul Volcker regime.
Okay.
And Jay Powell is no Paul Volcker.
I'd agree with that. From what I've seen. So obviously, I wasn't around there, but he was a lot more aggressive, and he just,
what, Tim, what's the last market to break when rates were 18-19%? They'd taken apart, broken everything. What do you think the last market to break was?
I don't know. Go on, tell me.
All right, corn.
Wow.
Yeah, because they can't print it.
Yeah, absolutely not.
Okay, absolutely not. Anyway, so you've given a lot of thought to, this is a period then where, if you're coaching or mentoring people, you're talking about patience.
Absolutely.
Right? And I have to self-talk, right? And I have this tweet that great surfers, like great traders, don't try and catch every wave. Correct. That they too have to be patient and wait for a good setup.
Yeah, absolutely, bang on. I like that a lot.
So how do you do that though? Do you step away? Practically, how do you do that? You have to step away. To just sit there, it's almost like it's more. There's nothing to do. Why am I sitting here? I ask myself.
Yeah, I mean, I think there's a really kind of just basic analogy that you can look at this as, right? The way that I kind of think of the market is it's an advertising mechanism. Maybe even you remember those? I think they're still around. Those shopping channels. Remember those shopping channels?
Yeah.
Like QVC and all of that. I think they're roughly still about. Not for much longer, but they're. They're there and they're advertising all the time, all this stuff, and they're throwing at you. And if you're watching it all the time, then you're tempted to buy whatever it is they're selling. And the same thing, anything like that, if you go to like a sales fair or whatever, you're constantly being sold to, and the market is doing that all the time. Whereas if you go shopping with a shopping list, then you buy the things only that are on the shopping list, and then you come away. Generally, you're going to do a lot better than if you just turn up with no idea and you just buy everything that looks nice or anything that's shiny or something that's got.
Are you married?
Special deal or anything.
Are you married, Tim?
I am.
And do you give your wife a shopping list?
For the
All right,
food,
that's a
for the
no.
food, yeah. For the food, yeah.
You try anyway, right?
Yeah,
Okay.
exactly. But it works for trading. You know, the analogy
Yeah.
kind of works for trading. It's you've got to prepare in advance and know what you're looking for, and
All
say,
right.
right, that's
Well,
what I'm
now,
going in to get today.
yeah, now we know Mrs. Vollans does not accept a shopping list from Tim. You know, you really are an excellent thinker when it comes to the markets and the things that you're seeing. So if people want to follow you, Tim, best way for them to do it is how?
Okay, so obviously on macrodesiac.com, okay, which
Okay.
you can find obviously up here.
Yeah.
All right, and again, our thing is just generally trying to bring in the macro side of trading. That's not so. We're kind of trying to demystify it and put it into everyday terms so that people understand it, because it's not really that complicated, you know. So follow us at macrodesiac.com or on Twitter as well.
Okay, and you could follow Tim on Twitter at VolaTim, right?
That's right. Yep.
Okay, and I want to thank you again. Good luck with your patience, and maybe next time we're talking, you know, we're at an inflection point. I kind of feel like we're at an inflection point when you don't know what to do.
Yes, I think that's exactly where we are.
So rooting for you.
You too, buddy. You too.
And thank you for your giving spirit to come and share what takes you hours of thinking and analysis to crystallize for people that you talk to, Tim.
My pleasure, mate. My pleasure.
Okay, everyone. So don't just count your pips, count your blessings, learn to be patient. And, you know, I guarantee you that every major Forex or equity broker will not invite Tim to talk about being patient and not trading.
No, absolutely.
What do you think, huh?
No chance. No chance. That'll be trading every minute of the day.
But you know what? He's for you, the trader. So thank you, my
Exactly.
trading warrior brother, once again.
Likewise, buddy.
Good luck, buddy.
You
All
too,
right,
man. Speak soon.
All right, and you okay? I'll get in touch with you on Twitter, and everyone else. So you could join the team in 15 minutes on the Morning Edge. Thank you for your attention. Hope we're adding value to what you're trying to accomplish, and perhaps a trader funding program might be able to help you out too. Adios, everyone. See ya. Thanks, Tim.
Thanks, Dan.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.